Hi class. We will be working on exercise 2.2, 2.3, and 2.4 today. Those are your cornerstone exercises. So if you give me just a second, I'm going to bring up Excel. And you should be able to see cornerstone exercise 2.2. In this exercise, exercise 2.2 is connected to exercise 2.3 and 2.4. We're going to be preparing the financial statements for a frozen food company called Petro. And this Petro company is going to be producing frozen pizzas. And so before we can prepare our financial statements, you need to realize that with a manufacturing environment, which this is what we're going to be looking at, with the manufacturing company, we're going to be preparing a statement of cost of goods manufactured first. This is the first financial statement that would be prepared. And on this financial statement is going to have all the costs that are associated with your product. Now, we are going to be producing frozen pizzas. And this year, Petro predicts that 50,000 units are going to be produced. And those 50,000 units had the following cost associated with them. You'll remember that your manufacturing cost or your product cost will consist of direct materials, direct labor, and factory overhead. In this problem, they split the factory overhead down into its variable components and its fixed components. You'll remember that the variable factory overhead will the total amount of the factory overhead, if it's variable, will either increase or decrease depending on the number of units that you produce. It varies. That's why they call it variable factory overhead. Some examples of factory overhead costs that are variable would be your factory supplies. The more products that you produce, the more your factory supplies would cost you. And so therefore it will be variable because it will vary with the number of units produced. Factory overhead can be broken down into its variable components, and also it can be broken down into fixed components. An example of a fixed factory overhead would be maybe if you're renting a factory to produce those pizzas, the factory rent would be considered a fixed amount. It would remain constant no matter how many units were produced. And what we're looking at right now in this particular problem are our costs and how they are affected. We're not looking at the unit cost at this particular time. They've also given you some information about the Petro company, that they are also going to be producing 119,300 of direct materials, and that they had some projected beginning and ending inventories for direct materials and work in process that are as follows. Our direct materials has a beginning inventory amount of 5,600. It also has a given ending inventory amount of 4,900. Your direct materials are those materials that have a high cost associated with them for the product that you're producing, and the direct materials will enter directly into the product that you're producing. So your direct materials would be the things that would go into the frozen pizza, such as your dough, your items that would make up the types of pizzas that you're producing. You might have pepperoni, sausage. All of these are direct materials. The beginning inventory comes from last period's ending inventory account that's brought forward. Your direct materials inventory account is actually a balance sheet account, and the amount of that inventory, the beginning inventory again, would come from last period's ending inventory account. And then this period, we would have to count our inventory too. We use these items on the cost of goods manufactured to help us to determine the amount of the direct materials used. You need to be able to determine the amount of the direct materials used first when you're preparing a statement of cost of goods manufactured. The cost of goods manufactured, we started in this textbook with our direct materials. You might remember from ACC 121 that we could have started with our beginning work in process amount. What they do is a little bit different of a format, and they put the beginning work in process down toward the bottom part of the statement of cost of goods manufactured. So really what they do is they start with their manufacturing cost. You need to determine how many materials that are direct that you have used during this period of time. You're going to do that first, and that's a major cost of producing the frozen pizzas. The direct labor would also be a product cost that would go into producing the pizzas, as well as your factory overhead, which would consist of the variable factory overhead that they gave us, plus the fixed factory overhead. I might need to talk to you a little bit about work in process inventory to refresh your memory about what work in process inventory is. Work in process inventory would be the materials that you started to work on, but you haven't completed them fully. So you may have started the pizzas but not finished them by the end of the accounting period, and you would want to know what that amount of inventory would be. The beginning work in process inventory comes from last period's ending work in process inventory. It's just brought forward. And then at the end of this accounting period, we would count our pizzas that we have started working on but haven't finished, and what's left over would be in work in process ending inventory. Again, the only thing they wanted you to do in this problem is to prepare the statement of cost of goods manufactured. So what I want you to know is how to prepare this in good form as I've got it written on this Excel spreadsheet. You're going to start with your direct materials, your beginning inventory balance, which was given to you. To that, you're going to add the amount of purchases of materials that you made throughout the accounting period. That too was a given amount. So I just plug those in, and then we add the materials that we purchased to the beginning inventory that we had of materials, and that will give us the materials that we have available to use throughout this time period. At the end of the accounting period, we count the materials to see what we have left over in ending inventory. We will deduct the ending inventory from the materials that are available, and that will tell us exactly what we've used in production. So our direct materials used in production is 120,000. That's the first part of your product cost that you would need to determine when you are preparing a cost of goods manufactured. To the direct materials that we've used, we're going to add our direct labor. Direct labor is the labor that we have to pay our employees that are working on the products themselves. So the people who are taking those materials and converting them to a finished good would be what the direct labor would consist of. Now, there are two types of labor. There's direct labor and there's what we call indirect labor. Indirect labor is the labor that would be associated with people that we're paying that are working in the factory, but they're not working directly on the product itself. Indirect labor will become a part of the factory overhead, which they're calling in this problem manufacturing overhead. Manufacturing overhead, the factory overhead, would consist of all the factory overhead accounts other than direct materials and direct labor. So things like indirect materials, indirect labor, those are a part of factory overhead. Your indirect materials would vary depending on the number of units that you produce. So indirect materials would be a type of variable factory overhead. Remember, we combined the two of those together. The given amounts were variable factory overhead at $25,000 plus fixed factory overhead of $220,000. That will give you the total amount of factory overhead of $245,000. You can also look on your spreadsheet here to see how I've calculated that. Your total manufacturing cost are your direct materials that you've used, your direct labor, and your total factory overhead. Those three items are combined together to get the total manufacturing cost. The total manufacturing cost for this period, plus the beginning work in process that was given to you, less the ending work in process that was also given to you, will give you the cost of goods manufactured. This cost of goods manufactured is going to feed into your cost of goods sold, which will become a part of your income statement. In the next exercise, they're going to ask you to take this amount and place it into the cost of goods sold section. So you need to use this again in the next exercise because they're really connected. You have to find cost of goods manufactured first. Then we're going to feed this amount into the cost of goods sold, which will be the next exercise. And then we'll feed the cost of goods sold into the income statement. They're all connected. In the cost accounting, they always like to add a what if analysis to your problem just to make sure you understand fully all of the concepts of the problem. And in this what if analysis, they're asking you, what if the ending inventory increased by $2,000? What effect would this have on the direct materials used, the total manufacturing cost, and the cost of goods manufactured? And what it will do is your direct materials, as well as your total manufacturing cost and your cost of goods manufactured, will all decrease by the amount of $2,000. On the spreadsheet, I've shown you how that would work. So if our ending inventory of our materials increased by $2,000, the original amount of our ending inventory for our materials was $4,900. We would simply add those together, which would make our ending inventory cost end up being 6,900. With all of the other things remaining the same, you can see that this amount of ending inventory that we had left over in work in process will decrease the amount of the direct materials that we've used in production. And that decrease in amount is going to decrease by $2,000. In other words, it was $120,000 before the ending inventory change. But when we increased the ending inventory by $2,000, it made our cost of our direct materials used go down. If our direct materials used cost goes down, then the total of our manufacturing cost would also go down. Notice that it would go down to $423,000. That was from $425,000. So if we had more ending inventory in our work in process, it decreases our materials cost. It will decrease the total manufacturing cost, and the total manufacturing cost, if they decrease, it will also end up affecting the cost of goods manufactured by making it decrease also. It went down from $422,900 to $420,900. So this is the what if analysis to prove it. Now in Cengage, they don't ask you to prove it. They just ask you what the amount is and you have to fill in the blocks. But I like to see it. I'm a real visual person, and I like to see how it flows through everything. And so basically all we did is we took the ending direct materials inventory, and it said that it increased by 2,000. So we would add 2,000 to that 4,900. That's how you get the 6,900. And that 6,900 is going to be deducted from your materials available. So it gives you less production cost for your direct materials. If you have less production cost for your materials, it also affects your total production cost. It'll make those go down. And then the cost of the goods manufactured, of course, would also go down because of that adjustment. I'm going to see if I can switch screens with you. So if you'll just hang on just a second, I'm going to see if I can pull up the next Excel spreadsheet, which would be Cornerstone. Should be 2.3, and I'm searching for that. Just bear with me just a minute. See if I can pull 2.3 up. Okay, I'm going to stop sharing for just a second. And I'm going to see if I can't go back in there again and share this with you. So hold on just a second. Let me make sure I've got everything up and running as it should be. All right. Okay, now you should be able to see Cornerstone 2.3. And again, it's a continuation of that same exercise that we were doing. They added some additional information to this, but basically what they want you to do is they want you to prepare the cost of goods sold section this time. So you need the information from the previous spreadsheet to start the cost of goods sold section. We start with our cost of goods manufactured, and the amount was $422,900. We're going to add to this our beginning finished goods inventory. And so you got to look at your instructions to see where the finished goods inventory is. The finished goods inventory, the beginning inventory is $42,500. It was a given amount. Your beginning finished goods inventory would actually come from last period's ending finished goods inventory that would be brought forward. They just gave you this amount so that you wouldn't have to go back and look at your records for this $42,500. But in the real world, you would. You'd have to look at your finished goods inventory account and see what the beginning amount was. Or you could look on your balance sheet and see what the ending finished goods inventory was the previous period, and this is where we would get this amount. Of course, it's a physical count that's taken of the finished goods inventory. This is the inventory that you haven't moved out of the warehouse. It's what you have not distributed to the customers. So you still got that inside the company. The cost of goods available for sale is your cost of goods manufactured plus your beginning finished goods inventory. This will tell you how much you have available to sell throughout this time period. At the end of the period, you'll want to look at your warehouse and take a physical count of what you have left in your ending inventory. In this case, it's $34,000, and again, that was a given amount. You're going to subtract the finished goods ending inventory from the cost of goods available for sale, and that will give you the cost of goods sold. This cost of goods sold figure will be plugged into your income statement, which is in the next problem that we're going to be looking at. And again, in this exercise, they want to really make sure you understand the flow of the cost through the cost of goods sold section. And they've given you a what if analysis. So they're saying, what if the beginning inventory of the finished goods decreased by $5,000? What would be the effect on the cost of goods sold? The cost of goods sold is decreased by $5,000. That's what it would affect it by. To prove it, you could put that beginning finished goods inventory, you would subtract the amount that was originally $34,000, you would subtract $5,000 from that. And so your beginning finished goods inventory, I'm sorry, I was pointing to the wrong thing. Your beginning finished goods inventory originally was $42,500. You're going to subtract $5,000 from this $42,500, and that will be your beginning finished goods inventory for the what if analysis. And then the steps are the same. Your cost of goods manufactured, which comes from the statement of cost of goods manufactured, plus your beginning finished goods inventory, tells you how much you have available for sale. Then you're going to subtract out your finished goods ending inventory, and that will tell you the cost of goods sold. You can see that the cost of goods sold has decreased from what it was earlier. So if you'll bear with me just a minute as I try to, I'm going to stop sharing my screen for just a minute. And I'm going to try to pull up yet the last exercise that I want to talk to you about today, which will be Cornerstone Exercise 2.4. and that's going to be your income statement. So you should be able to see again that this is the same problem. It's just that they're adding different parts to it. And in this part, what they've done is they've given you some additional information. They still are telling you that the finished goods inventory, beginning finished goods inventory is 42,500, and the ending finished goods inventory is 34,000. Now they've added to it that they've got selling expenses at 26,000 and total administrative expenses of 134,000. As well, it says next year this company wants to produce 50,000 units and sell 49,300 at a price of $12.50 each. So you need to know how many units that they are expecting to sell. You've got to be able to calculate the sales on your income statement. This is the format. It's really a short income statement, multi-step income statement that they're reviewing with you. On the income statement, we'll start with our revenue account, which is our sales. We're going to take the 49,300 units that we were expecting to sell, and we're going to multiply it by the selling price for 1 unit. When we do that, that'll give us total sales of 616,250. These are your costs that are associated with the income statement. They also wanted you to show your percentages. And so I'm going to start with our cost. We see how we're calculating the sales. The number of units sold times the selling price per unit will give you your total sales. And then you're going to pick up your cost of goods sold, which was from the previous exercise. The dollar amount of the cost of goods sold was $431,400. You're going to subtract your cost of goods sold from your sales amount, and that will give you what we call gross profit, or in this textbook, they're calling it gross margin. So gross margin or gross profit can be used interchangeably. The gross margin is the difference between your cost of goods sold and your sales. It's what you have available to cover your operating expenses. Your operating expenses would be listed next, and operating expenses consist of selling expenses as well as administrative expenses. For our selling expenses, I believe that was a given amount, and it's right here. Total selling expense are $26,000. You didn't have to separate them out as you do on the actual income statement itself. They've just grouped it all together as one category here, trying to simplify it for you. Since these are beginning exercises and there just should be a review to you, we're trying to keep it as simple as possible. Your administrative expenses were also given at $134,000. Selling expenses plus administrative expenses will give you your total operating expenses. The total operating expenses for this period of time is $160,000. The operating expenses total would be deducted from your gross margin to give you your operating income. Your operating income is your income before any other items. And so these are the cost amounts, or this is the dollar amounts that you can see here on this statement. They also wanted you to review with you the percentages for your income statement. And the percentages all are based on sales. So when we talk about a sales percentage, sales is always going to be equal to 100%. We get this percentage by taking the total sales and dividing it by itself to get the percentage. So in other words, what's in cell address C27 is divided by C27, and that will give you 100%. If you divide this out, it will give you the number 1, but they wanted you to convert it to a percentage, so you move your decimal 2 places to the right, and that would be the amount of the percentage. Be really careful and read your instructions carefully when you're doing any of your problems in Cengage. They have some right weird rounding in this particular textbook, so make sure you read how to round so you'll understand what they're talking about here. For your cost of goods sold, we'll take the cost of goods sold amount and we'll divide it by our sales. That will give us this 70%. In Excel, you'll have to change it to a percentage for it to work out, because if you just took, let me demonstrate that for you. If you just took the dollar amount and you divided it by the sales amount, it would give you this. So they want you to show it as a percentage, and the rules were that they want you to carry it out 5 places. So 5 places you would carry this out to, and then you would round back. And in this case, the percentage amount is 70%. Now, I believe that I've taught you before in a managerial accounting that you could simply subtract 70% from 100%, and that'll give you the gross margin. But again, you got to be careful because of these rounding items here. So it might be a good idea for you to take the amount of your gross margin and divide it by the sales. And that will give you this figure right here. And then once it's rounded properly, you'll round it to this percentage here. Remember, you're going to take your decimal out 5 places, round it back to 4 places, and then move your decimal 2 places to the right. So it ended up being that it's rounded up to 30% here. You're also going to be asked to calculate the percentage for your total operating expenses. So what you would do is you would take your total cost of your operating expenses, divide it by your sales amount, and that will give you the decimal portion of this. But they want you to convert it to a percentage. And so this is the percentage that they want you to enter into Cengage. Carry it out 5 places, round it back to 4, and then move your decimal 2 places to the right. And that will give you the percentage. For your operating income, it's done the same way. You take your total amount of your operating income, divide it by your sales percentage, and that will give you this, and then round it or make it a percentage like this. So technically, you wouldn't be wrong if you were to deduct 25.96 from the 30%, it will still leave you with approximately 4.03%. But Cengage is really funny, and you have to do it exactly like they want it for it to grade it properly. So I'm going to take this back off, and hopefully I haven't confused you too much with that. Just remember that you're dividing everything by sales to get your percentages. In part 2, it says, what if the cost of goods sold percentage for the past few years was 65%? What would management's reaction be, or what do you think it would be? Originally, it was 65% in previous years. If we look at this, we can see that our percentage for our cost of goods sold has increased by 5%. So we would want to know what caused the cost of goods sold to go up. So we might want to investigate our manufacturing costs to see if we could determine why this went up by 5%. If it was something that we could control, we would want to make management decisions to help us to better get this in control the next period. So what these percentages do is they help management make decisions about the company. And so that's the what if analysis for this. So that's all of your financial statements reviewed. So it's important for me to know that you know how to do the cost of goods manufactured, the cost of goods sold section, and the cost of goods sold section is fed into the income statement. Then you would do your retained earnings statement for a corporation and the balance sheet. But we're just concentrating on, in this chapter so far, what's happening with the income statement. You must do the cost of goods manufactured first, feed that amount into the cost of goods sold, which is fed into the income statement. And so I'm going to stop here. Hopefully we've got everything recorded properly this time, and I will see you next time. Thank you. Bye-bye.